All right, let's dive into a really important part of options trading, the risk measures that everybody calls the Greeks. Now, I know they sound super complicated, but they're not. Think of them as the dashboard for your trades, showing you exactly what's going on under the hood. I mean, seriously, think about it like this. Would you drive a car that didn't have a speedometer or a gas gauge or any warning lights? You'd be moving, sure, but you'd have no clue how fast you're going, or if you're about to run out of gas, or if the engine is overheating. Trading options without understanding the Greeks is pretty much the same thing. They are your dashboard. They make all those invisible market forces totally visible. So before we get to the dashboard, let's just do a super quick refresher on the vehicle itself. What exactly is an option anyway? The easiest way to wrap your head around it is to think about putting a down payment on a house. You pay a relatively small fee today to lock in your right to buy that house at today's price sometime down the road. You don't have to buy it, but you have the option to. See? Okay, so here's the more formal textbook definition. The most important phrase in there, the one you gotta remember, is right, but not the obligation. That's the whole game. The person who buys the option has all the power. They get to choose whether to act or not. The seller, well, they're obligated to do whatever the buyer decides. And every single option contract is built from the same 4 pieces. You've got the underlying asset, that's the stock or ETF you're betting on. You have the strike price, which is that price you locked in. There's an expiration date, which is your deadline. And finally, the premium. That's just the price you pay for the contract itself. It's your down payment.
Okay, great. We know what an option is. But what makes its price go up or down? It's not as simple as you might think, which brings us to what I call the pricing puzzle.
Now, the first thing everyone thinks of, and for good reason, is the stock's price, right? If you have the option to buy a stock at $100 and that stock suddenly shoots up to 120, your option is obviously worth more. That makes perfect sense. But that's only one piece of the puzzle. There's this other kind of sneaky force at play, and that's time. Every option has a ticking clock on it, that expiration date we mentioned. It's what we call a wasting asset. Every single day that goes by, your window of opportunity gets a little smaller, and the option loses a tiny bit of its value because of it. And then you have the real wild card, market volatility. This isn't about what the stock did in the past. It's all about what the market thinks it's going to do in the future. If everyone expects a lot of drama and big price swings, options get more expensive because there's a better chance for a huge payout. So you've got the stock price, time, and volatility all pushing and pulling on your options price at the same time. How on earth do you keep track of all this? Well, this is where our team comes in. It's time to meet the Greeks. Now, this is super important to get right. The Greeks are not crystal balls. They don't predict the future. They are simply risk metrics. Each one isolates one of those forces we just talked about, price, time, or volatility, and tells you exactly how sensitive your options price is to a change in that one specific factor. Now, there are a bunch of Greeks, but honestly, you're going to spend most of your time with the core 4. So let's meet the team. Delta, Gamma, Theta, and Vega. And if you're just starting out, pay extra close attention to Delta and Theta. They represent the 2 biggest forces you'll face every single day, the stock moving and time running out. First up is Delta. Just think of this as the speedometer on your dashboard. It tells you how fast your options price should change for every single $1 move in the stock. It's your most direct measure of price sensitivity. So what does that actually look like? Well, an option with a low delta is kind of sluggish. The stock moves $1, and your option might only move, say, 20 cents. But an option with a high delta? Whoa, that thing moves almost in lockstep, nearly dollar for dollar with the stock. It gives you a really clear picture of the kind of leverage you're getting. All right, so if delta is your speed, what's gamma? Simple. It's your accelerator. It doesn't tell you how fast you're going right now. It tells you how quickly your speed is about to change. So gamma measures the rate of change of your delta. If you have a high gamma, it means your option's delta is going to change really fast as the stock moves. It's like you're just tapping the gas and the car's lurching forward. This is a huge deal for options that are right near the strike price, where things can get pretty wild. Okay, next up is Theta. And this one is the bad guy for anyone buying an option. I call it the time thief. This is the Greek that measures that constant, nagging drain on your options value from the simple passage of time. And here's the thing about Theta. It's not a steady drain. It's sneaky. For an option that's a year away from expiring, it's like a slow, steady drip. But once you get into those last 30 days or so, that drip turns into a fire hose. Time decay accelerates like crazy. Theta tells you exactly how many pennies your option is set to lose tomorrow, just because the sun came up. And last but not least, rounding out our core four is Vega. Think of Vega as your volatility gauge. It has nothing to do with the stock's price direction and nothing to do with time. It's all about market fear and greed, or what we call uncertainty. What Vega does is measure how much your options price will jump or fall for every 1% change in that expected drama. When people think big news is coming, like an earnings report, volatility shoots up, and Vega shows you just how much that's going to inflate the price of your option. Okay, so we've met the whole team, delta, gamma, theta, Vega. But knowing who they are is one thing. Seeing them work together, that's where the magic happens. This is where the rubber meets the road. Check this out. Let's say your stock went up by 50 cents. Great. Thanks to delta and gamma, you'd expect your options price to go up by about 22 cents. But wait. On the same day, market volatility dropped a bit, and Vega tells you that took away 14 cents. And, of course, a day went by, so the time thief Theta snatched its 2 cents. So what's the net result? A 6-cent gain. Without the Greeks, you'd just be scratching your head, wondering why your option barely budged when the stock went up. And that right there, that's the whole point. This quote just nails it. This isn't about fortune telling or predicting where a stock is going. It's about seeing and understanding the different risks that are affecting your position right here, right now. You see, the Greeks take all these invisible forces, price movement, time decay, market emotion, and they put them right on your dashboard, clear as day. They turn what feels like a gamble into a calculated assessment of risk. So the only question left is, are you ready to start checking your dashboard?